Okay, let's dive into something that's, well, probably way more surprising than it sounds. Where does money really come from? I mean, we use it every day, but the conventional wisdom, it might be missing a pretty crucial piece.
Yeah, what's fascinating, is we often picture money just moving around like water in a closed system. Savers deposit, banks lend it out.
Right, the standard story.
Exactly.
Yeah.
But the insights we've pulled together for you today from excerpts of Making Money Work by Sekerke and Hanke, and also some points from another file, #.txt, they really kind of shake up that traditional view.
And we should say this isn't just some like fringe academic thing. These are ideas getting attention from serious people in finance and economics names like Kevin Dowd, Harold Oleg, Mark Calabria. They see this as a fresh, important perspective.
Absolutely. So our mission for you today really is to unpack this complexity. We want to give you a much clearer understanding of how money is actually created, the vital role banks play, and, well, all the forces shaping our financial system.
We're going deep, but the goal is those aha moments, right? Where it clicks.
That's the plan.
All right, let's jump right in then. One of the most maybe eye-opening concepts. Banks don't just lend existing deposits. They actually, what, create money when they make loans.
That's precisely it. The authors quote a really key idea here. They say it's much more realistic to say that the banks create credit. That is, that they create deposits in their act of lending than to say that they lend the deposits that have been entrusted to them.
Wow. Okay.
And that's not just semantics, It fundamentally changes how we should think about what banks actually do.
So this picture we have of like individual savers driving the supply of credit, that's just incomplete.
From this perspective, yes, very incomplete. The traditional theory, as the book points out, it mistakenly attributes to them an influence on the supply of credit, which they do not have. It's just not how it works, fundamentally.
Instead, banks extend credit, they create new deposit balances, and that function is economically similar to creating actual legal tender.
Exactly. It has a similar economic effect.
Yeah. Okay, here's where it gets really interesting for me. This credit creation. It's not just like shuffling numbers on a screen, right? The sources suggest it can lead to the creation of real capital. How does that work?
Precisely. Think about it. When a bank creates credit for, say, a productive purpose, a new factory maybe, or vital infrastructure,
Okay.
that newly created money is then used to buy equipment, hire workers, build things. That process can directly increase the economy's actual productive capacity. That's the real capital they're talking about. It's not just financial fluff.
Got it. Now, the sources also stress that when we say banks, we often need to think bigger than just, the local branch. We need to understand universal banks. Let's dig into that. What are they and why are they so important here?
Right. So the term banks often really means these large financial holding companies, BHCs or FHCs, you might hear them called. Think of them as big umbrella organizations. And commercial banking, the credit creation bit we've been discussing, that's just one part of what they do. They're also heavily involved in financial intermediation, capital market stuff, connecting investors with companies needing capital through stocks, bonds, that sort of thing.
So you've got credit creation and capital market activities happening side by side, sometimes even competing within the same huge company.
Exactly that. They might compete for resources internally, for clients, for focus. And what's also significant, the sources note, is that these universal banks often operate in the shadow banking world, to financial activities happening outside the main regulatory structures.
Which makes understanding them even more crucial, I guess.
Yeah.
If they're involved in both regulated credit creation and these less regulated areas.
Absolutely. Grasping how these universal banks operate with their sort of dual personality and shadow activities, it's key to understanding the whole monetary system.
And regulating them becomes a really powerful lever for monetary policy then, affecting both the amount and the direction of credit.
That's the argument, yes. It's a major tool, maybe even more direct than just interest rates sometimes, for influencing credit volume and where it flows.
Okay, now let's shift to another interesting concept. Credit rationing. This isn't just about interest rates deciding who gets money, is it? There's more to it.
That's a really crucial insight from the sources. Credit rationing means that even if you're willing and able to pay a higher interest rate, the bank might still say no.
Why?
Well, interest rates alone don't perfectly balance everything. They don't fully clear the market for loans or perfectly align saving and investment intentions. Other factors come into play.
Like these ideas of investable versus bankable projects the sources mention. What's the difference there?
Okay, so an investable project is one that, on paper, looks like it should make money. It has a positive net present value. you know?
Makes sense.
But to be bankable, it needs more.
Yeah.
It needs to meet the bank's specific lending criteria. That usually means things like solid collateral, the borrower having enough skin in the game, their own capital at risk, and a really predictable income stream the bank feels comfortable with.
So you could have a brilliant, potentially profitable, investable idea, but if it doesn't tick those specific boxes for the bank, maybe because it's too new or relies on intangible assets, it might not get the loan. It's not bankable.
Precisely. And this rationing of bank credit, it has a parallel in capital markets, something called equity rationing.
Okay.
And the sources suggest that when there aren't enough projects meeting both the investable and the bankable criteria, you see this interesting effect. A flood of money looking for a home, often ending up in safe assets like government bonds.
Yeah.
It's like a default option when good lending opportunities seem scarce.
Which brings us back to a fundamental question the sources tackle. What is money, really? It's more than just coins and notes, isn't it?
Yes, much more. They argue money is primarily a unit of account, a shared way we measure value. And this system, it doesn't just spring up. It's established through collective action, often facilitated by the state.
And it's based on credit relationships, promises to pay.
At its core, yes. Money is constituted by these credit relations, these claims and obligations, which are spread unevenly across the economy.
So money isn't neutral. Changes in how much money there is or where it comes from actually change things in the real economy, beyond just inflation.
Absolutely. The sources really emphasize the non-neutrality of money. Changes in the quantity of money, they argue, tend to follow changes in these credit patterns. It's not just dropped from a helicopter, so to speak.
And you need some kind of authority to maintain a stable system. It doesn't just self-organize perfectly.
Right. Markets and monetary systems aren't entirely self-organizing or self-stabilizing. They need an authoritative standard.
There's that powerful quote from Ingham. The very idea of money, of abstract accounting for value, is logically anterior and historically prior to market exchange. What's the essence of that?
It basically means that before you can have efficient markets, you first need a common abstract way to measure value, the unit account function of money. Without that shared yardstick, bartering is incredibly complex and inefficient. The accounting comes first.
And this uneven creation of credit we talked about,
Yeah.
how does that play out? The real estate market example seems key here.
It's a perfect example. Think about the huge expansion of credit, specifically channeled towards real estate over recent decades.
Yeah, massive.
Banks, often funded through capital markets, were willing to create vast amounts of money backed by property values. This obviously fueled the housing market, drew resources away from other potential investments, and, importantly, significantly changed the terms of trade. People who already owned property benefited disproportionately from all this new purchasing power being created.
It definitely has distributional effects. Okay, let's talk monetary policy then. We usually think central banks, interest rates. But the sources push for a broader view, right? Looking more at the money supply itself.
Exactly. Adjusting the policy interest rate is one tool, sure. But the argument is that bank regulation, things like capital requirements, liquidity rules, these have a massive, if sometimes less visible, impact on how much the money supply actually expands.
They directly constrain or enable that bank credit creation we discussed.
Precisely. And fiscal policy, government spending and taxing also plays a part. Maybe less in the total amount of money, but certainly in where that money flows and which sectors benefit.
Which brings us to measuring money. Just adding up M1, M2, whatever.
Yeah.
That might not be the best way. The Divisa approach comes up. What's different about it?
Okay, so simple sum measures just add up different types of money, cash, checking accounts, savings accounts. Division is more sophisticated. It tries to account for the user cost of holding each type of money. Yeah, like the opportunity cost. Holding cash means you're giving up interest you could earn in a savings account, right? Divisa weights different money types based on how useful they are for transactions versus how much you give up to hold them. It aims for a better measure of the actual monetary services being used.
And when you use these Divisa indices, what happens? Does it make a difference?
Well, the research cited suggests that when you use Divisa, the demand for money looks much more stable over time.
Which is important. Why?
Because if money demand is stable and predictable, then policies aiming to influence the money supply might actually be more effective and have more predictable outcomes. There's even data showing a better correlation between this user cost of money and inflation when using Divisa.
Interesting. The sources also look at where money growth comes from: banks, non-banks, the government. Any key shifts there?
Yeah, the breakdown shows that the relative importance of these different sources has changed quite a bit over time. Sometimes bank lending dominates, other times government deficits or non-bank activities play a bigger role. It gives you a much richer picture than just looking at the total.
Okay, let's zoom in on the banks themselves. What's happening on their balance sheets? Table 7.8 in the book shows some long-term U.S. trends. What jumps out?
Well, historically, loans were clearly the dominant asset for banks. That was their main business. But post-global financial crisis, there's been a noticeable shift.
How so?
Loans make up a smaller share of their assets now. They're holding relatively more securities and significantly more liquid assets, cash and reserves.
And this is happening while capital markets are muscling in on traditional bank territory like mortgages and corporate loans.
Exactly. Big overlap there, which leads to some really fundamental questions the sources raise. Such as, are capital markets basically taking over the financing of projects that banks used to handle? Is the old idea of savings being scarce even true anymore? And maybe most importantly, if the pool of traditionally bankable projects is shrinking for banks, how are they going to meet the economy's demand for money creation going forward?
Big questions, which loops us back to bank regulation. What's the main goal there, and how have things like the Basel Accords shaped it?
The absolute core goal is to preserve the moneyness of bank deposits, to make sure you and I trust that our money in the bank is safe, accessible, and the bank itself is sound. That's job one.
And Basel.
The Basel Accords, Basel the First, then two, now three, aim to create international standards for banks, mostly around how much capital they need to hold against their risks and how much liquid cash they need on hand.
Right, trying to prevent failures.
Yes, but the sources point out that Basel III, while designed to address GFC risks, hasn't necessarily pushed banks towards making more traditional commercial loans. Well, rules like the liquidity coverage ratio, the LCR, they incentivize banks to hold lots of super safe, high-quality liquid assets, or HQLA. Think government bonds. That boosts stability, sure, but it might also tie up capital that could otherwise have gone into loans for businesses or individuals.
So it's a trade-off. Let's bring the government back in. Beyond spending and taxes, it acts as a monetary authority too, doesn't it?
Absolutely. Things like deposit insurance are a huge government backstop for the whole system's stability. And then you have government debt issuing bonds and the central bank buying that debt. That can directly impact the money supply, though maybe not always instantly. The plumbing is complex.
And we can't forget those government-sponsored enterprises, GSEs like Fannie Mae and Freddie Mac. They loom large, especially in housing.
Hugely influential. They basically shape the entire U.S. mortgage market, how it's funded, who gets loans, and other entities too, like the Federal Home Loan Banks, FHLBs. They act as important lenders within the banking system itself.
And again, all these government actions, spending on healthcare, housing subsidies, education loans, they have real distributional consequences, changing who has purchasing power for what.
Definitely. Monetary and fiscal actions are never truly neutral in their impact across society.
Which brings us to this idea of neutral monetary policy. The sources define it a bit differently, don't they? It's not just about hitting an inflation target or some natural interest rate.
Right. They argue for a concept of neutrality focused on minimizing the distortions monetary policy causes across different sectors of the economy. The goal should be to avoid messing up relative prices too much.
So let price changes reflect real things like technology or productivity shifts, not just monetary factors pushing one sector up and another down artificially.
That's the ideal, yes, to minimize those uneven sectoral impacts.
Okay, let's touch on competition. In banking itself and between banks and those capital markets, what's the landscape look like?
Well, you've got different theoretical models, perfect competition with lots of small banks, oligopoly with a few big players, banks as platforms. Since the GFC, though, there's been a sort of tolerance, even encouragement, of more concentration, especially with these GSIBs, the globally, systemically important banks.
The too big to fail concern, but also maybe seen as more stable.
That's the tension. There's this ongoing debate. Does concentration bring stability, or does it stifle competition and innovation? It fuels the argument for maybe separating commercial banking, the deposit-taking, loan-making part, from investment banking, the capital markets part again.
Back to Glass-Steagall, in a way.
Something like that, yes.
Now that recurring theme, bankable projects. Real estate keeps coming up as the classic example. Why is it so favored by banks?
Historically, it's tangible. Land generates rent. It's hard to move, relatively easy to value and seize if things go wrong, and often gets favorable tax treatment. It ticks a lot of the traditional bankable boxes.
But there's a concern, right? That in our modern tech-driven, intangible economy, there are fewer of these classic, easily collateralized projects.
That's definitely a concern raised. If value creation is shifting towards software, data,
Yeah.
brands, things that are harder to use as traditional loan security, does that limit bank lending?
Right.
Or the counterargument is this is an opportunity. Banks need to innovate, find new ways to assess risk and structure loans for these 21st century types of businesses and assets. It's a challenge, but maybe not an insurmountable one.
The sources also mention the global saving glut. What's that about and how does it connect?
It refers to this phenomenon observed over the last couple of decades where there seems to be an excess of desired saving globally, particularly from certain countries, but also from wealthy households and even corporations holding lots of cash.
And this ties into,
It ties into the growth of debt capital markets. All that money needs to go somewhere, and if there aren't enough perceived high-return equity investments or bankable projects, a lot flows into bonds and other debt instruments. Some argue this might represent a missed opportunity, channeling capital into lower return safe assets instead of riskier but potentially more productive equity investments.
so pulling all this together, what are the big recommendations for moving towards, let's say, a smarter monetary policy framework based on these sources?
Well, several key ideas emerge. One is reconsidering the separation of commercial and investment banking. Let each focus on what it does best, perhaps reducing conflicts of interest.
Okay.
Another is rethinking bank regulation. Maybe move towards risk weights based more on actual profitability of loans rather than just potential loss, which might lead to a more neutral credit allocation.
Interesting.
Also, maybe shifting how banks manage liquidity risk, relying more on standing facilities at the central bank rather than hoarding massive amounts of HQLA themselves,
Bring up balance sheets a bit.
potentially. And crucially, really emphasizing the need to monitor the distributional impact of money growth, using those Division indices, perhaps, to track how broad money is flowing across different sectors of the economy, not just looking at the aggregate.
To get a handle on those non-neutral effects we talked about.
Exactly. The argument is that focusing on these areas could lead to a more effective and, importantly, a more neutral monetary policy.
Okay, so let's try and recap the big takeaways from this deep dive. It seems pretty clear. Banks aren't just passive intermediaries. They actively create money when they lend.
Fundamental point, yes.
Universal banks are these complex beasts, juggling credit creation and capital markets, operating in regulated and shadow spheres.
Right. Understanding them is key.
We've got credit rationing. Interest rates aren't the whole story. Money itself is deeply tied to credit relationships and isn't neutral. And bank regulation is a huge lever shaping the whole system.
You've got it. Understanding these underlying mechanics, it gives you a much richer, probably more accurate picture of how finance really works, beyond the sort of textbook simplifications.
It definitely feels like peeling back a layer. So here's a final thought for you, the listener, to chew on. Given that banks literally create money, what does that mean for growth and stability as our world gets more digital?
Yeah, how will the nature of bankable projects change? What constitutes good collateral in an information economy?
And what about those ongoing debates about the role and regulation of these huge universal banks? Where should that go?
Lots to think about. Hopefully this deep dive has given you a much clearer framework, a better lens for considering those questions going forward.